Hello, everyone, and welcome to another episode of the AI Investor Podcast. Today, we have an extra special guest on, Eric Jhonsa, who I used to work with at the Motley Fool. We're going to cover a lot of stocks. We're going to cover market conditions. Should be a pretty action-packed episode. So, Eric, thank you for being on the show today.
No problem. Glad to be here.
So, once again, my background with you is we had worked together, but I think it was almost 15 years ago at this point.
Yeah,
So
about that
maybe we
much.
should just Yeah, maybe we should just catch up and check in what you've been doing since that time, and if you want, just kind of talk about your background in investing in the technology space.
All right. Yeah, done a few different things since like the Motley Fool days. For a few years, I was handling Seeking Alpha's tech news coverage, so I was like the tech editor for the news service. After that, I worked as the technology columnist for The Street and Real Money. That was from 2016 to 2020. And like I also did some like news reporting, like interviews with executives and earnings live blogs, things like that. Also during that time. And at the end of 2020, I quit that. And at the time, I was thinking I would start a Substack and then maybe just trade stocks a bit on the side, to supplement my income. But I found that I enjoyed trading a lot more than writing, and it started going really well for me. So I've just kept doing that. And that's trading has basically been my full-time job for the last 4 years. I also do a little bit of consulting work for a money manager, based out of upstate New York. But my main source of income and my like primary job has been trading stocks for the last 4 years.
Living the dream. You said live in Phoenix in Boulder right now,
Yeah, I
traveling
live in
around.
Phoenix, but I'm in Boulder, Colorado for a few weeks right now. Just wanted to get out of the Phoenix heat for a little while during the summer.
Could be worse. Could be worse. So I know you won't say so yourself, but Eric's one of the best follows if you're on Twitter or X, and you actually share your portfolio on a monthly basis, which is very generous. Most accounts don't want that kind of accountability, or they charge for it. So it's a good place. I'm sure we're going to talk about lots of trading ideas from that. But Eric, let's just dive right in. That you've been an active investor through the dot com era. You've been an active investor through the growth of smartphones, and now we're entering this AI phase. So I just kind of wanted to hear from a really, 5,000-foot view how this current phase compares to past eras that you've been investing in.
Yeah, there are, similarities and differences, I feel. In term you can draw some parallels for sure with the dot-com bubble in terms of how there's been like popular euphoria over a major new tech platform that's creating all these economic and social changes, and how there's been a major spike in like Capex and in VC funding related to that euphoria, and also how there has been like some bubble behavior in certain companies. There are similarities there, but I think there are also some like key differences. I think during the dot-com bubble, the froth was a lot more widespread than it is right now. Like triple-digit PEs were very common during the dot-com bubble for tech companies. You had all kinds of chip and component suppliers trading for well over 100 times forward earnings, and that's rare. You have some today that maybe fit the bill, but it's much rarer right now. Like even Microsoft, I think back during the dot-com bubble had a forward P in the 60s. Today the tech giants, they often have forward Ps in the 20s, and even Nvidia is around 30, and that's based on an estimate that I think might be too low. So like, yeah, yes, there is froth today, but it's not as widespread as it was during the dot-com bubble. I'd say the other big difference is that on the Capex side, there was massive overcapacity during the dot-com bubble in terms of fiber capacity, server capacity, and so on. It's back then, I think the fact that broadband penetration was still very low, consumer hardware was much more limited. Smartphones were in their infancy, PCs were much less powerful than they are today, and so on. That limited, how much of that bandwidth could be used, how much of that server capacity could be used. Whereas today, AI compute demand remains above supply. All like the hyperscalers keep talking about how they're compute constrained. They have to set rate limits. They have to, kind of ration the capacity they give out to their customers. And at the beginning of this year, some of the hyperscalers were talking about like having supply catch up to demand by mid 2025, but it still hasn't. Now they're talking about demand being ahead of supply at least in early next year. It could be longer than that. So that's like a massive difference. I feel like, there was this giant overcapacity back then, and for the time being, that's not the case right now. I do think, in some ways, one analogy I've made is that the AI boom is kind of like the PC boom in the late 80s and early 90s. After Windows launched, as point and click GUIs took off, and developers they were scrambling to create apps that could take advantage of this new interface. And PC sales were taking off. Back then, hardware was like a major limiting factor. It really meant a lot to like have like an expensive PC compared with a cheap PC. Just having that more like the processing power, the RAM, the hard drive space, that was like important. And you can say something similar like with AI right now, where the hardware limitations kind of like just are a gating factor, in terms of what apps take off, what services take off. And as like compute capacity grows, as data centers, their total compute capacity just becomes more and more powerful, then, new apps and services can take off. And I think we'll keep seeing that in the coming years.
Yeah. So I don't want to do the baseball analogy of what inning we're in. We're constantly seeing that, but I did like what you touched on, that when we started this podcast, we started last summer at the tail end, and it was, are we going to see some of this supply demand imbalance start to change in the middle of 2025? We saw the DeepSeek moment at the beginning of the year, and now we have obviously hyperscalers all taking up their capex expectations dramatically for this year. I would just be curious, what are your thoughts on, going through 2026 without any major hiccups for a lot of these data center plays? Where do you start looking out and start going, I feel like I have less uncertainty at that phase? Are you pretty confident that throughout 2026 we're going to see a pretty tight, situation in terms of demand relative to supply with a lot of these infrastructure plays?
Yeah, I'm pretty confident about 2026. I think it's mostly in the bag at this point. Like the tech giants have been signaling they'll keep growing capex next year. Meta signaled that they'll be spending a lot more next year. You see research notes like indicating, capex forecasts are still getting taken higher. I think Jeffries and Fubon just like came out with a note like hiking their forecast for Google's TPU orders like rise by like they raised their TPU forecast for next year by about 50%, I think. Semi Analysis just had a report, talking up on AWS's data center plans and, suggesting like their AWS's revenue growth is going to go higher. So, like, it does feel like I'm not too worried about 2026 capex, especially also when you look at like how much funding companies like OpenAI and XAI and Anthropic have raised, and how they plan to use that funding, and how much backlog growth there has also been for the public cloud providers, for Azure, AWS, and GCP, and that backlog can only be fulfilled if they spend more on capex to meet that demand. So, like, yeah, I think 2026, I'm not that concerned about really with when it comes to capex guides. I think what needs, more attention, I guess we paid for, is just whether demand keeps staying ahead of supply. Right now, like, it's still ahead of supply, and I think there are reasons to think it could stay ahead for a little while. It's still very early for things like reasoning models and agents and AI generated video, and all that's just going to keep driving more and more compute demand. I think, as like the capacity grows and as the token costs keep dropping. So there are reasons to be like cautiously optimistic that, that demand can stay ahead of supply, but at the same time it's worth watching just given how much capacity is being added this year and next.
Yeah, I think what you touched on there is very in line with what we've talked about on the show, that a lot of the past spending's far more rational than a lot of the media coverage. But with Meta making this next step up, it does start going for ASI. And there are some worries there that, this could be, hotter spending than what we've seen in the past with, again, these companies racing to catch up with demand. Also, you touched on the semi-analysis piece, moving Amazon by 4% today. Pretty
Right.
remarkable
Yeah, I
that
mean,
research can move
speaks
something
to the
that
quality
large.
of their work. They do their
Yep.
homework, in terms of researching like the data center builds and the orders and companies replace them and all that. So yeah, but it is impressive.
Yep. We've been very complimentary of their work. One question I would ask is, we'll shift towards talking about some individual stocks. As I know, did you make your portfolio public? You're disclosing performance on a monthly basis. So I was just curious, from a high level, before we talk about individual stocks, what segments of the market are you most interested in right now? I know when I look through your portfolio, I see a lot of micro caps. I see a lot of ideas across, countries. I see a lot of ideas across. You will have some mega caps. You do have Taiwan Semiconductor in there, but it seems like you tend to skew to smaller ideas in general.
Yeah, I feel like it's a lot of times if you're looking for high upside bet, that's a good place to look. I mean, I do have some large caps. Well, I'm long, companies like Nvidia and C, and a few other larger companies. But yeah, a large percentage of the portfolio is in small caps, just because when I'm looking for things that really could have high upside that are like underappreciated, that's a good place to look. And particularly like right now, like since 29, since 2009, large caps have like strongly outperformed small caps in the U.S. And it's I think that's produced an investor bias too, both among retail and institutional investors towards large caps in many places. And I can understand it in some ways. Part of the reason large caps have outperformed is the massive success of the tech giants. Just given how much they've grown their revenues and profits and how their share prices have followed, that's a big factor. And also like small caps, it's a place where you have to separate the wheat from the chaff. It takes some work. You can find some. I think you can find some very cheap companies there that are quality profitable companies, but you can also find a lot of junk, and it takes work to figure out what's what. So I can understand that, but after such a long run of large caps outperforming, and how it's created these large valuation deltas, often between large caps and comparable small cap companies, I just feel like small caps are a good place to look right now in the U.S.
All right, so let's get to some of the individual stocks we want to talk about. You make your portfolio publicly available. It should be noted here, we'll talk about some positions you diversify very broadly across
Yeah,
different positions. So you are not making anything too outsized. And we should put that out there right at the front. I know you'll talk about which stocks might be more speculative versus not. But one of the more speculative stocks is Tecogen. It's a stock we recently added. We talked about how speculative it is, but I always love seeing some validation. I didn't know that you own this. I love that you're looking at as well. Could you just talk about maybe what caught your eye with this company and kind of the broader opportunity in thermal management?
yeah. I mean, I agree. It's a pretty speculative name. It's not a name that anyone should invest money that they can't afford to lose. But with that higher risk, I think could come like a higher potential upside too. Tecogen makes chillers for data centers, and they announced a reseller deal earlier this year with Vertiv, which is like the biggest player in data center liquid cooling. And Tecogen makes natural gas powered data center chillers, which they argue are like have lower operating costs than like electric chillers, and they also argue that their natural gas powered chillers are more efficient than rival gas powered chillers. And it's a company with about a $200 million market cap and with about 26 million in trailing 12-month revenue right now. But their revenue could easily like soar above 100 million if they can just land like just a few like major orders for their chillers, whether through the Vertiv partnership or otherwise. They said in like their last earnings report that they got a letter of intent for a 100 megawatt plus data center that could go up to like 500 megawatts, and that they also provided quotes for 60 to 100 chiller orders, from two other potential customers. So they land a few deals like that, their revenues are going to take off. And you just like look over the next few years, data center power and cooling needs are going to soar, just because of how like power hungry GPUs and other AI accelerators are, and like how high like rack densities are becoming in terms of power. Like Nvidia's GB300 server consumes about 120 to 130 kilowatts of power in just one server rack, and that's something that would have been unheard of a few years ago for one server rack to consume that much power. And you look out a couple of years down the road with Rubin Ultra, NVIDIA is going to have like 576 reticle sized GPU dies in one server rack. That's up from 144 today with Blackwell. So that's just going to require a ton of power and cooling, and that's it's going to be a big growth driver, I think, for Vertiv, and also for companies like Tecogen potentially, and also for power semiconductor suppliers. So it's definitely an area that's going to see a lot of growth over the next few years.
Yeah, we love the broader cooling space. I can see, you're really seeing this quarter, especially with a lot of the big Blackwell systems getting to customers. Some of the networking stocks, just seeing, it's been one of the big stories this earnings season, right? With Credo, and we could go on and on.
Right.
There's been a lot of them. Sienna today.
Yeah.
Um, But I can see liquid cooling being an area that's going to attract a lot more investor attention in the next 12 to 18 months. So let's talk about maybe an unloved area at the moment. I noticed you added Monday. I,
Mhm.
I I think this is a newer addition, if I'm correct.
Yeah.
This is a stock that dropped 30% after what seemed like fairly reasonable earnings, and we've kind of had this deep seek moment for software where a lot of leading names have sold off fairly aggressively across the summer. So, could you talk about, why you added Monday, but also how you feel about this software setup and how you're positioning yourself with a lot of these names that are becoming much better values?
Yeah, I bought Monday, I think like around 171 or something like that, after the sell-off. And I think Monday is fairly unique among higher growth software companies in that you can value it based on their free cash flow, even after you back out their stock comp. A lot of like these high growth software companies dilute shareholders like crazy. They issue tons of stock comp. And Monday is fairly disciplined by comparison. I think the stock currently trades at like 32 times its 2026 EV to FCF multiple after backing out their trailing stock comp. And that FCF estimate maybe could be too low, just given how well the company's executing, how well its earnings and FCF estimates have kept going higher. I think the stock got hit post earnings due to some worries about the impact of like Google algorithm changes on their organic traffic on an SEO. It feels a little overblown, given that they're still seeing 20% plus growth. They're still taking like share in the work management software market, particularly among larger businesses. And they're also like expanding more into like they're seeing growth in like CRM and service management software areas like that. So it still seems like a quality growth story, and like I said, it's unique in terms of how you can value it even after backing out their stock comp. Then, as far as software in general, I feel like, yeah, it was kind of a deep seek moment in terms of the panic people had in terms of the fear, the impact AI and like vibe coding could potentially have on just software top line growth. I think it's partly due to a misreading of how sometimes people look at how software is sold. You just look at like how many for how long like open source software has been very popular, and yet you still have like major open source developers that do hundreds of millions or billions in revenue. You have companies like Red Hat and Elastic and so many others that just do a ton of revenue just from their even though like much of the code that they're distributing is available for free, just because enterprises want that support. They want the ecosystem that these companies provide. They want they need like these sort of assurances, that you're getting, that the software is reliable, and there's a lot of other stuff that goes into it. It's just because software, the cost of creating code and the cost of you know producing code is comes down doesn't necessarily mean that software is going to be upended. I feel.
Could I maybe follow up with one more? GitLab. I think, is GitLab in your portfolio?
Yeah,
That one is down 8%. It's a stock that we've owned. It's clearly become a battleground stock right now. How'd you feel about that? A little conservative guidance, but seemed like a great quarter overall.
yeah. It seems a little overblown, just like given how much the stock is sold off, and now it's like the trading at close to 5 times forward sales. And they're still seeing pretty healthy growth. And I've seen people comment that they might be sandbagging their guidance just because the CFO is leaving, and just to make it easy for the newer CFO. And they talked on their earnings call about how much of their growth is still coming from a seat growth rather than pricing, which is an encouraging thing. I think there's just been fears with GitLab that that like some of these AI tool developers like Replit and Cursor to lead into their business. But so much of their business isn't necessarily just about code gen. It's about managing software projects. It's about managing tools and so on. So they can it doesn't have to be either or. Companies like Replit and Cursor can grow well, and I think GitLab could still do well even in spite of that.
Yeah. And, still a lot of the growth avenues from AI itself, Duo, still in beta. We're still at such an early phase for some of the expansion opportunities for these stocks. I want to ask about Tower Semi. I saw you own that. This is a stock we've never talked about on the show, but it's attracted a lot of attention. I mentioned earlier how research from Semi Analysis had driven up Amazon 4% today, which is incredible for a stock of that size. They recently had published research on Tower Semi It's up about 30% in the past month. You own this stock. Could you talk about the broad opportunity here and whether this is maybe one that some investors are missing?
Yeah, I bought Tower Semi like in the 40s. It's a stock. I'm not looking to add it to my position here, but I'm also not looking to sell any shares for time being. I think they have like a big opportunity with silicon photonics. It looks like on their last earnings call they signaled that their silicon photonics shipments are going to soar next year, and this is like silicon photonics is an area where I think you know just the AI infra capex is just a massive tailwind right now, particularly given how much networking and optics have often become a bottleneck for AI clusters. And they have like customer engagements with companies like Coherent and Marvell and InnoLight, so like a lot of major optics players. And there was like recent Substack from I think an account called Irrational Analysis. It's like an anonymous semiconductor engineer, and he suggested like Nvidia might also become a client, going forward with their silicon photonics. So they have a major growth opportunity there. And I think the stock is only trading at like 22 times its 2026 EPS consensus. And that consensus, just given how much silicon photonics is ramping, could easily be too low. And then beyond that, they have a few other growth opportunities. They make silicon germanium chips that go into various data center networking products. They make image sensors that go into like industrial machine vision and automotive applications. They're manufacturing power envelope tracking chips for Apple's upcoming iPhone lineup. And then I think they're also like working on OLED on silicon micro displays for like AR and VR headsets. So there are a few other growth drivers there. And more broadly, as their sales grow, as their fab utilization grows, their margins should go higher in tandem.
All right. So there's maybe we've talked about Taiwan Semiconductor, a different foundry idea for people. Let's talk about some short stocks. You maintain a long positions and you maintain short. You're normally net long, but we don't short on this show. It takes a little more bravery, I think, than I have, but you will go after especially some of the most let's call them frothy segments of the market. I noticed one area that you have several short positions in is quantum stocks. How would you describe your overall feelings about quantum, and are there any stocks in the space that you currently are optimistic on?
Oh, yeah. I think quantum is one of those areas where you can like really draw some parallels with the dot com bubble. I think it's true bubble behavior here. You can like make some comparisons, I think, with quantum computing companies and with like deeply unprofitable dot coms, from like 2000, like companies like Webvan and eToys and Pets.com. Quantum computing, maybe like 10, 15 years from now, it could be a meaningful commercial market. But right now, it's very much in the R&D and science project stage. Like you listen to like companies talk about when quantum computing could be commercialized, major companies and researchers in the space, and suggest it's still like probably at least 5 years away, and it could be longer than that. Like back in January, Jensen Huang, made some noise by like saying that like the quantum computing is probably at least 15 years away from being commercialized, and maybe longer. And all the quantum stocks immediately tanked on that, and so it's going to take a while, before quantum really becomes commercially viable on a large scale. And and the other thing is, even after that happens, it would take time for like the developer ecosystem to form, for developers to be comfortable with using it, for businesses to get comfortable adopting it and to commercialize it. And then, on top of that, it's, far from clear, once if that happens, which companies are going to be the winners. On top of like all these like independent quantum computing companies, you have companies like IBM and Microsoft and Google who are investing in the space. Potentially they're the major winners rather than like these smaller, companies like IonQ and D-Wave and Rigetti and so on. So it just feels like an area that's seen a ton of fraud. In spite of everything I just said, like IonQ has a $12 billion market cap. I think it trades for around like 70 times next year's revenue consensus. D-Wave is worth like 5 billion and trades for like 110 times next year's revenue consensus. And then Rigetti and quantum computing, two other quantum stocks, I think they have like 7 billion in equity value between them, and they have like less than 10 million in trailing revenue. So yeah, like I said, it just feels like a total bubble, and it's going to end badly at some point.
Soundhound is another short. Last week we had Simon Erickson as a guest on the podcast. He suggested Soundhound as one of his higher conviction AI plays. So I was just wondering, is this a valuation short, or is there something that you see with their ability to get traction in some of their kind of newer initiatives with kind of agentic ordering and some of their growth areas? What are you seeing when you look at Soundhound?
Valuation is a big one of the big reasons why I've shorted it. I think SoundHound trades for like 27 times forward EV to sales or something like that. And I think that's like the third highest valuation among US software companies that I track. I think only Palantir and Cloudflare have higher forward EV to sales multiples than SoundHound. And on top of that, they're still posting major losses. They're not close to being profitable right now. And while their like official revenue growth is pretty high, a lot of it's been boosted a lot by acquisitions. Particularly the Amelia acquisition last year. I saw like one estimate that their pro forma revenue growth last quarter was only 20%, even though they were reporting revenue growth well into the triple digits. So that's worrisome. And then they've been massively diluting their shareholders, both through stock comp and M&A. So that's another big issue with them. And then finally, it seems like their accounting is pretty aggressive. It's like I've seen people point out that they were recognizing like long-term unbilled receivables as revenue last quarter. It's not a normal practice for software companies. So like all these things are concerns. And then I guess finally, the conversational AI software space is fairly competitive. You have companies like Google and Microsoft that will offer like machine learning APIs for conversational AI. You have very smaller companies like Cerence and a whole bunch of startups that are also going after the space. So yeah, SoundHound is one of the major players there, but they're far from the only one. So we combine all of that, the valuation just looks nuts to me right now.
All right, and the last space I want to tackle, just in your short book, nuclear. It's something we've avoided here. There's a lot of promise to the general concept, but there's a lot of stocks trading for very rich valuations. And you talked about revenue figures for quantum. We have most of them even further pre-revenue in some ways. So, what are your opinions of nuclear in general? And maybe are there any spaces that you are playing as far as the power bottleneck we're seeing? I don't know if that's independent power producers or anything else that catches your attention.
Yeah, I've got two nuclear shorts right now, NuScale and Okla. They're both small modular reactor developers. And, I do think SMRs will see meaningful growth in the coming years, but it's also a place where I think the hype is well ahead of reality. It's like for the time being, NuScale and Okla have like very little revenue, and SMRs take like I think 3 to 5 years to construct, even after like the regulatory approvals happen. And each SMR I think produces only up to like 300 megawatts of power. So these are truly like massive like power plants that are being built. And on top of that, this is clearly a capex intensive business. It's not like software or something that's really high margin. So for all those reasons, I think the hype has kind of gotten overblown. And in spite of that, like NuScale and Oklo each have market caps around $10 billion a piece. So that just like feels very frothy to me right now. In terms of power bottlenecks, I do have a few handful of like power AI like power plays. I've been long utility solar stocks for a little while. I think it's an area where like the valuations fall from very low. Partly because of all the political worries about IRA tax credits being revoked and just other political opposition from the Trump administration. But the valuations are low. The ROIs for solar and battery storage projects have improved a lot over the last decade. Particularly like in Sunbelt regions. That get just the high levels of solar energy. And the hyperscalers, like Google, Meta, Amazon, so many of them have like renewables commitments. They're like to offset like whatever power consumption and growth they have, like with like renewables commitments. And just because their power consumption has been growing so much due to AI capex, solar naturally benefits from that. I do think some of the easy money has probably been made here. Just these stocks have bounced in recent months. After like the IRA cuts weren't as bad as feared. The Treasury ruling wasn't as bad as feared, so they've seen a bit of a run up. But at the same time, like I think valuations for companies like First Solar and Next Tracker are still quite reasonable. So the stocks could keep working from here. Another area where I have like some power exposure is like companies that make generators for AI data centers. I've been long a company called Power Solutions International. Symbol is PSIX. The stock has had a pretty big run, but it's still fairly cheap. I think it trades for like 18 times trailing earnings. And they're still seeing massive growth for generators from data center clients. I think the revenue was up over 70% annually last quarter. And, I wouldn't say that's necessarily going to last, but there is still a ton of demand. I think they can still see very healthy growth, in the back half of this year and also in 2026. And then yesterday, I just took a long position in Generac. They're well known as like a provider of generators and like power storage solutions for homes and businesses. And they're just now like entering the data center generator market. And they've quickly like built up $150 million backlog of data center orders, and they're going to fulfill like much of that next year. And I think that backlog should grow a lot going forward. Like they said on their earnings call, like next year there could be like a 5,000 generator shortage in the data center market, and each of these generators like sell for about $1 million a piece. So that's like a $5 billion revenue shortage potentially. And this is a company that does like a little under 5 billion in revenue right now, I think. So even if they just tack on 500, 600 million in data center revenue, from to help address that shortage, that's a lot.
The shortages in some of these data center spaces are incredible. If people listening recognize Power Solutions, that is a stock we talked about 2 episodes ago. So that is something that might have been on their radar. But I do want to move on to macro. We talked about a lot of stocks there. Let's talk about the big picture before we close today. As I noted earlier, you maintain a portfolio that's both long and short. You're generally net long. I'm just curious, what are some things that in the back half of the year in 2026, you are most worried about? What do you look at that you believe could make you go net short, or also kind of, take the steam out of this rally that we've been on since early April?
Um, I think looking like say 3 to 6 months out, like maybe like medium term, inflation and treasury yields are like the biggest concerns for me. For the time being, inflation is still subdued, and like long yields are still in check. I think the 10-year yield is still only around 4.2%. So while that's the case, I'm like fine being that long. But I think there is a risk that inflation could shoot higher in the coming months. There are a whole bunch of different things that could be inflationary. You have tariffs, you have a weaker dollar. I think you have potentially tighter blue collar labor markets due to less immigration, and as well as onshoring. That can drive wage growth. You have massive AI and manufacturing and energy capex. You have like major fiscal deficits, and then you also just have wealth effects and like looser financial conditions. So all that stuff could be inflationary. And on the flip side, like AI efficiency gains could be deflationary. Low oil prices could be deflationary. But the list of things that are inflationary risks is much higher than the list of things that could be deflationary. So that concerns me. And then you just combine that with the fact that the Trump administration is pushing for lower interest rates, and so it's not clear that like if inflation does shoot higher, the Fed would be able and willing to deal with it. Like inflation soared in 2020 in 2021 because of all the money printing and deficit spending that went on. But the Fed did have a free hand in 2022 to raise interest rates a lot to help deal with it, and that kept long yields in check. That led to the yield curve to become inverted, and eventually things worked out. 2023 and 2024. But this time around, it's not clear that the Fed will have like the leeway to do that. That it'll be able and willing to just hike interest rates to keep inflation in check. And if they fail to do that while inflation soars, then I think the 10, 20, 30 treasury yields, they're going to take off. They're going to blow out. And you could also see the dollar plunge, and which would make inflation even worse. So that's, I think, a risk as you look further out. I do at the same time feel like I don't want to jump the gun here. When the 10-year is still only around 4.2%, when inflation prints for the time being haven't been that bad, I don't want to go net short. I'd rather be net long, particularly given that institutional position still isn't that stretched. And you also look at like various sentiment gauges like investors intelligence or AAI or like equity put to call data. It doesn't, it shows an up. Sometimes some of these gauges show an uptick in bullish sentiment, but they don't show extreme bullish sentiment. It's not necessarily as like high as it was in late 2021. So, given all of that, I'm comfortable being net long for the time being, but I'm, certainly keeping an eye on the inflation data and I'm keeping an eye on treasury yields. And if, you start to have issues in those areas, then, who knows, maybe in a few months I'll be net short.
Key highlight there, still net long, but some very reasonable areas to be concerned with. Let's close with just kind of a overarching question. You're a bit of a unicorn. You are one of the most knowledgeable people I've ever met across technology. You are interested in a lot of spaces that used to not have as much investor interest and now have tremendous investor interest. So you've gone through cycles. You have a very deep background in technology. With a lot of new investors being attracted to artificial intelligence and maybe not having invested through the dot-com era and the growth of smartphones and some of these other mega trends, having gone through these cycles yourself, what's one piece of wisdom that you'd want to impart on someone who might be newer to investing or kind of working through their first mega trend as an active investor?
Yeah, that's a tough question. There are, I think, a few different things, that would matter, that would be important. I'd say like one place to start is one thing I would certainly stress is just that like investor, if you're starting out, you should be looking at valuations and financials instead of just narratives. There's been, thanks to social media and YouTube and whatever else, there's just been such massive growth in like narrative based investing where people hear about a hot tech trend and they pile in. And, maybe sometimes, there's, the hype is justified, at least to a large extent, like with AI infra and, certain other areas, there could be significant growth. But, then you could also have something like quantum computing where there's just like a lot of hype and vapor and, there's very little revenue and, the companies that people are piling into are losing a ton of money. So it's important to like look at the valuations, look at the financials. I do feel like, in recent years, markets have often rewarded a lot of bad behavior in terms of just chasing growth and narratives and not looking at valuations, not looking at financials. But that won't last. That won't last forever. So I'd say that's like certainly an important thing.
And we saw definitely one example of getting a comeuppance for that was early 2021, which wasn't that long ago.
Right.
Definitely a period with a lot of excessive speculation. So, Eric, last thing I wanted to do is just give you a chance to have people listen to this. If they want to follow your portfolio, if they want to get insights from you, what's the best way to kind of stay up to date with your investing?
I guess my Twitter account would be the best place. My handle is just my name, Eric Jhonsa, EricJhonsa. Um, you know, I guess I share like my portfolio once a month, or sometimes a little more than that, on the account, and I'll also just like comment on tech news and interesting things I might be finding in like research reports or articles or whatever else. Yeah, that's like the main way I try to like communicate with people online.
Right, there we have it. Go out, follow Eric. He's a great follow. Twitter, it's not perfect, but it is a great space for it's a great community for investors if you can kind of curate the right people. So Eric's a good start for it. Eric, I think that's all we have to cover today, unless there's any burning things you wanted to say before we go.
No, I can't think of anything right now. Yeah, it was good to talk with you. I feel like we covered a lot of different things here, and yeah, it was a fun conversation.
All right. Well, I just wanted to say to everyone out there, we expect to be back next week with one of our regularly scheduled episodes where we'll cover the portfolio, add some new buys. And until then, I hope everyone enjoyed this interview, and we'll see you later.